My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content.
All right, guys, welcome to Property Profits Podcast. I'm your host, Bryce Kaminsky, filling in for Dave Dubow. And have you ever wondered how to strengthen your real estate investments through the power of vertical integration? Well, today, my guest, Arleen Garza, co-founder of REEP Equity based in San Antonio, Texas, is here to share her insights and expertise on this fascinating topic. Arleen, welcome to the show. Great to have you here.
Great to be with you. I think it's awesome that you have the podcast that shares some great information with other folks out there. I've found in my journey that listening to others helps you learn a lot, but it also helps you avoid mistakes. So I think that's phenomenal that you are putting this on.
Yeah, I mean, I get a lot of value out of it too, just listening to the stories, and I get to ask the questions, so I get the best seat in the house. So with that being the case, the best seat in the house, how did you get started in real estate? You obviously didn't start an equity fund and managing all this multifamily assets. What was the stepping stone from, I don't know anything about real estate, to now I'm doing real estate?
Sounds great. Well, I was in banking for 20 years, so in corporate America for 20 years. And my husband had a property management software company. And in 2007, get that timing, he received an offer to sell the business, so he took it and then was out of the business, out of that world, and it was property management software. So along the way, he had seen what owners were doing that were using his software. He had about 20,000 users at the time. So after he sold, he came to me and he said, what would you like to do? And I said, I don't really know. I do know I want to move to San Antonio because my mom is there and others are, my family are here. So we made the decision to move here, spent a few years educating ourselves and waiting for the lending environment to thaw out from the 2008 financial crisis. So in 2012, we were looking for an investment that we could control, that wasn't going to generate more in taxes. We just paid taxes on the sale of his company, and that wasn't as volatile as the stock market. So we bought a 24-unit property here in San Antonio and made the crazy decision to run it ourselves. We had never done that, but we felt that the only way to know the ins and outs of it was to run it ourselves. So we did. I did leasing, he did the rehab and managing the maintenance side of it. And then from there, bought a property around the corner so that we could hire a part-time manager, free up a little time, and then bought 88, 143. Fast forward to today, we've purchased 33 assets, about 6,000 units, and have bought, managed, and sold 10 of those assets. So currently we have about 4,400 units, 720 million or so in value in our portfolio. And along the way, you talked about vertical integration. So approached it a little, the first 5 that we owned, we managed ourselves. Had a regional, had an accountant, and community managers, et cetera. But then when we hit about at that point we said, mentor said, you should consider third-party management because you're so busy in the business that you're not working on the business. So we tried third party for about a year, a little over a year. And in that time we grew, we doubled, and now we had 1,000 units. And so we had been told that's about the magic number where you can hire the appropriate staff to bring the properties back in-house and manage them ourselves again. So we did that. We hired more people and then decided, you know what, this is the model that works for us. It doesn't work for everyone, but it did for us. And so it's allowed us to build scale in San Antonio. And then we moved to Houston in 2019 and bought our first asset there. built scale in Houston, and then now the latest market is Austin, that we bought a property and are looking to build scale in that market also.
So with the vertical integration, taking on the management of, taking it from the third party and building out your own, were there any challenges along the way for, like you got to learn it, then you moved it off your plate, then you took it back onto the plate, put some people in the positioning, and now you manage that. So what sort of challenges was going on during transition there?
So the big transition, and I would say this is a tip for anybody who is considering that, is when we took it from third party, all of your accounts payable, all of the vendors that have been paid, all of that data sits with your third party management company.
Mhm.
And the minute you take it over and you let everybody know, hey, we're doing this on our own now under our umbrella, all types of vendors show up and they're presenting invoices that they say were never paid. So one of the key things for us was to ask for all of the canceled checks that had been issued and paid to vendors so that we could avoid some of that. Now you still have some of those gray areas or those holes that you have to patch just because the software itself, if you are not using the same software that the management company prior to was using, there is a little bit of a delay in getting all of that data into the system. So my recommendation there is, if you're going to be transitioning to your own software, get really good at it, or at least have a training session with that property management software company so that you can identify where there might be issues in converting data over. And one big area is websites. Today, most of the software companies embed your websites for your individual properties into their system, into their software. So when you're switching out of that, you've got to be able to have your websites up and running very, very quickly, because today's world, all the leasing happens pretty much online, or at least the first look from potential residents is coming through your website. So having your websites transitioned over, having them operational is really key. In fact, when we buy a new property today, we call it the day one difference. The day we show up on that property, the software is operational. The marketing brochures are printed. The staff has been hired 2 weeks before and trained on the software and on our processes. And so those things are key when you take over a property, to be able to function, to be able to hit the ground running on your renovation plan, on your takeover, you name it. So those are some key things that I think you need to be aware of. And one huge, huge piece is the accounting. The accounting piece of it is super important because you're going to be reporting to your investors, and data in, determines the data out. And so making sure that your processes from an accounting standpoint are solid. I can't stress that enough, because that can really create some big issues for you if you don't know what your financials are and you can't trust the financials that you're getting from your software.
Yeah.
So that's a big
Well,
one.
that too is like, you run the
That's
report. Let's say you're like, okay, here are investors, here's the report, and maybe some of them don't even open it. And then there's the investor who's like 10 spreadsheets deep on you, and they're getting reports that don't make sense. And now they're saying, okay, well, why is it that the people managing the property are delivering reports that don't even make sense to me? And I'm not even the person managing it. And so it creates that tension between the investor and the project manager, because it's like, I thought the reports were good, but this someone who's like overseeing more closely their money is saying, well, that doesn't add up because I did my own report. I pulled the whole thing, I put it in a pivot table, and turns out there's missing data. So what's going on now? When you look at REEP Equity and the track record, managing such a volume of millions of multifamily assets, what strategies have you implemented to achieve that growth that people desire so much?
Well, one of the interesting things is we always do a strategic planning session towards the end of the previous year. We don't wait till the year has started. And one of the things we do is we try to project our growth, which I would tell people, even if you own one property today and your goal is to buy 4 next year, project that growth. And then what we do is we build out a skeleton org chart. What will it look like, or who will I need on my team to achieve this level of growth? And if, let's say, you're planning to buy 2 properties between, call it March and September, then you know that you're going to need to have the capability to manage those 2 properties in those, 6 months. So who do you need on your team? Are you okay with your regional staff? How many units are they already managing? Your accounting team, how many properties are they all managing? And so you build out this org chart in advance of the growth. And that has saved us tremendously, because then we can say, okay, we need to budget to hire this number of people in May. So how many management fees do we need, or how many asset management fees do we need to pay for those folks? And so the on-site staff, they're paid by the property, but your corporate staff are paid from your property management fees. So you've got to be able to have enough of those fees to pay for the people that you need to run these properties successfully. So it's all about planning. A lot of it is about planning and getting ahead of where you think you're going to go. And you may not acquire 4, you may only acquire 2, but you're ready for the 2 that you acquire because you plan for more than what you thought. One of the things we've always done is to hire ahead. So even though, we may have
might cost you a little bit at the beginning of like underutilized staff, right? But
right. And that's okay, because you can cross-train them during that period of time into other areas. And so you get a stronger team versus hiring them after you've already grown and everybody's running around crazy, which is never what you want. So plan your growth and try to see what your team needs to look like for that growth.
yeah, so kind of like laying the pipes before you turn on the water. And people are
Exactly.
like, let's just add more units. And it's just like, everything's broken again. Better hire more people. And then it's like chasing the water downhill. You're like, quick, get out the buckets. And it's just like,
Right.
it sounds like a bad time all around.
It
Now,
does.
one of the things you mentioned, providing better living situations for residents and also ensuring that the financial success of the project for the investors, I mean, balancing that's a remarkable achievement in itself. How does REEP Equity balance those 2 objections within the operation side of things?
So it really starts with your upfront underwriting analysis of the property that you're going to buy, right? So what we typically like to do is we shop the competitors in the area. We find out what amenities do they have, what do their units look like, because whether it's an A or a B class, you want to know what is selling today and what are they pricing for that value for those units or that property. So we will typically go through that process and come up with a capital expenditure budget on the front end. And it's important that you don't raise too much, but on the other end, the last thing you want to do is not raise enough, because your business plan, your ability to add value to that property is coming from the money you put into it, right? So for us, of course, we start with the outside. And that starts even before we, put an offer in. We drive it, we look at it, we take our capital projects manager over there and we say, okay, what do you see? Roofs look okay, the big stuff, right?
What's that crack in the brick
Exactly.
problem? Oh, it
So,
goes all the way down.
right.
That's
Now,
not good.
at that point, we haven't had a chance to go into the property, so we don't know what it looks like other than the pictures in the offering memorandum or on their website. So we have a good idea, but sometimes those pictures are old, right? Sometimes it's
Mhm.
not the latest picture. So putting your eyes on it is important. So the acquisitions teams put together a budget, and then they share that with our operations team, our management company team. And they say, does this look about right? And the biggest piece of their look is on the units. Are we, is what we're putting into the units what we need to put in?
Mhm.
Flooring, hard surface flooring is always a seller. In today's world, we are doing hard surface countertops because we know we can get at least $75 in rent for hard surface countertops, or
Mhm.
more. But at a minimum, we know 75. And then some of the other things, cabinets. We very rarely go in and change out cabinets. One, it's a very expensive endeavor.
And
But
usually it's a fashion thing anyway, it's like,
yeah,
oh, they're dark
yeah.
and today it's white and then 5 years from now it's dark again. And it's just like, maybe just the handles. How about the handles?
Yes. Yeah. So we're looking for those things. And then we put in what's called jewelry. And you may go, what is that? Well, it is the handles. Light fixtures. You would be amazed at what some non-expensive, cool looking light fixtures will do for getting a resident to rent from you. So
Mhm.
that's a big piece of what we look at. And then we do some other things like hands-free faucets. So you can walk up to the faucet, run your hand underneath it, water turns on, you run it again, it turns off. So that is not only saving water potentially, but you don't see that a lot in Class B assets. You might see it in the luxury units, but you
Yeah,
don't
like
see it
a
in Class
Class
B
A.
assets.
Yeah.
So we're trying to get closer to some of the things that are offered in the Class A's at a much more convenient price. So that and LED mirrors. You've been to hotels where you can tap it and the LED light
It
comes
doesn't
on.
take much. And it's interesting, like the feeling I'm getting is we can attract the A clients down into a B rent and then they'll never be unhappy because of the value exchange because they're like, wow, I get all these like kind of bells and whistles that I would get in an A, but I'm saving like $800 a month because maybe it's not on Broadway or whatever, but it's, and I still get my parking, I still get all the stuff and look at my fancy things and I can have a house party and oh, look at my nice hard countertops. We used to do the same with flipping. We'd have what was called like a first fixture. So like the first one that you walk in on, you'd be like, oh wow. And it doesn't take much. You could easily put a nothing dome light there for $11,
Right.
or you could spend $49 and put like something a little bit more on trend. And that's the feeling, right? The emotional sale.
It
So,
is. It's someone's home, right?
well,
And
hopefully,
so
I like the hard surfaces though. The carpets in tenanted properties are a very short-lived expense. They may make it through one tenant, typically not.
I agree. And now people are concerned about allergies. And so with the hard surface, that eliminates that, issue. And
Pest
then
control as well too, because carpets and any bug, underlayment, whatever, they're in there.
I agree. So that's been a big thing for us. And then on the turns, when somebody moves out, as you said, and you're coming back in to redo that unit, we save a ton of money because a lot of times you find, for example, on the countertops, resurfacing, right? You might have 10, 15 layers of resurfacing and it looks pretty good, but it won't last. And each time you do it, it's $200-300 for the resurfacing of these counters. Well, if you use the hard surface, you're paying for it up front, but you're not going to pay for it on as you go. And so
Mhm. Like
you can,
we just did chop block in one of our units, resurfacing. Sand it all down, take all the marks out, put the new, refinish the countertop. And I'm saying to the manager, I'm like, you know, the cost of just not doing this again is like you pretty much paid for this countertop again every time you do it. Because you could buy this MDF countertop and just put a new one in, 200, $300. But here we are remanufacturing a countertop to save what, $500 at the
Right.
beginning?
Yeah. And, you know, in our underwriting, our repairs and maintenance budget is lower because we're not going to have to go in and repair those items. We're replacing them on the front end with something that's more durable. And so when the lender's underwriting your loan, they can give you credit for a lower repairs and maintenance budget because you've proven why it's going to be lower. And that's because you're not replacing the flooring, you're not replacing the countertops, which tend to be some of your more, you know, costly items. So just being aware of all those little things that can cost you money is important. Plus, you know, the experience for the resident. I think resident experience is top of mind right now for everybody because there's been a lot of new deliveries, a lot of new units that have been coming onto the market. And so, you know, if you can keep your resident, man, you're going to save so much money from not having to redo that unit. And not having the acquisition cost of that new renter coming into your property.
Gotta pay the leasing agent, gotta pay them up first month, pay it up.
Right.
You don't want
So,
that turn. You don't want that turn at all.
right. So your resident experience is much better if they're coming into it. And I'll give you an example. When we're doing stoves, we're doing the glass top flat stoves. And some people in the beginning said, oh, well, don't they damage them? And won't the resident tear it up? And I said, no,
Maybe.
but think about this.
Maybe.
Maybe, but we give them the cleaning supply to start with that shows them how to clean the top without scratching it. And the beauty of it is we don't have those elements, those burners to replace every single time. And if you've ever seen a stove that's had those, even if you replace the burners, it doesn't look good. I mean, the
No, it reminds
cleaning
you
of
the
it.
80s.
Yeah,
And there's
yeah.
particular tenants who are like, oh, this type of stove is perfect for doing drugs with, you know, and
Yeah,
those that's where you find that because it's a feeling, you know, there's a feeling of it's almost like what you project is what you can expect. So if you went in there and you carpeted the whole thing and you know, got out the caulking gun and just recalked the tub and, you know, the mirrors, the same one, you know, maybe you just kind of cleaned it up, you're gonna attract that tenant. And when you put that nicer stuff in there, it's interesting. Nice things scare bad tenants. They're like,
interesting.
ah, this is too, I don't feel comfortable here.
Right.
It's too nice for me. And it's like,
Yeah.
cool. You're
Yeah,
probably right then.
so it's those little details, you know, on our last property we bought in Austin, the regional said, I want to put in the thicker baseboards. So when we looked at it, that's an expensive proposition just because it's one, there's a lot of work, but
Yeah, linear footage too.
exactly. So she said, I'm going to buy the machine that helps them cut it. So our team can do it in-house and it will save us money in the long run because if you look at the baseboards, again, they've been painted 15, 20 times on an 80s assets. And so even if you give them a nice new coat of paint, they look like they've been painted over and over and over.
So a few times.
Yeah, so we were looking to differentiate ourselves, and those baseboards, those thicker baseboards are doing the trick. And instead of paying a lot of money to do it, our team can do it in-house with the right equipment. And so those are the little details that go a long way, as you said, to attract that better renter that we're
Well, and
looking
a
for.
lot of the damage in a tenanted unit happens close to the baseboard anyway. So if you made it a little taller, you know, you could probably catch a few more dings in the drywall.
That's exactly right.
So, you know, 5,500 units over San Antonio, Houston, Austin. Are you noticing any trends right now in the real estate market, and, you know, how do they influence your strategy in investing?
Yeah, so one of the big trends is centralization. You know, the Texas Department Association just had their big conference, and that was a topic that was kind of woven into a lot of different educational workshops. And so it's about how do you centralize some functions to create a better resident experience. For example, some of the companies are centralizing the assistant manager, the person that does the collections. And we've done that using AI. So we haven't gotten rid of the position, but through AI, we've reduced fraud. In terms of people coming in, there's been a lot more fraudulent documents that are presented by renters when they come into your doors. So using 2 levels of verification, we've reduced that in the first month by 23%.
Yeah, the finessing the landlord.
Yes.
Oh, this is my pay stub. Is it though?
It's a lot of times it's not, but these systems we're using can tell us when they're fraudulent. So we've been able to improve the fraudulent, identifying the fraudulent documents by 96% using this AI generated tool. So it didn't require another human, but it does 2 things. Not only are we preventing people who are giving us fraudulent documents from coming in the door, it's saving us money on evictions, right?
Well, and
We're
you're
not
not wasting the leasing agent's time too, because it's like, oh,
exactly.
it's already a nonsense document, throw it in the trash.
And so that leasing agent can focus their time on other tasks, taking care of the resident and showing units, things that are going to generate more money for you. So centralization is a big topic. I think it's going to get even more prevalent in the future as more tools and more technology items become available to our industry. So that's a big one. And I think the other one is, how do you improve the resident's experience? You can read Google reviews all the time, right? We read reviews to decide if we want to go to a restaurant. And if they've got a bad rating, we're probably not going to go there. Same thing happens with apartments. So we now have a system in place where if the review is good, there is a system generated approved by us message that gets posted. If it is not to our satisfaction, then the AI tool sends a notification to that community director, says, hey, you've got this review that just hit.
You got
You
a
need to
problem.
invest.
Pizza was cold.
Right. So you have to investigate
No
it.
hot water for 3 weeks. It's like, oh, that's a problem that we
Yeah.
should, be on top of.
So the manager is now community director, manager, whatever you want to call them, is now focused on identifying those issues and responding to those issues. Because you can save a resident if you respond and take care of something. If you ignore it, the whole world knows it, and you're going to lose that resident when it's time for renewal. So doing things that are going to help your resident experience and improve your turnover. So the industry average is 50%. 50% of renters in most rental environments turn over every year. So we upped our goal to move that number to 65% using these tools, using this focus on resident experience, and we're hitting it. So consequently, when you look at the national averages for vacancy, and and you look at it by city, and it's in the high 80s in some cases. Ours is, mid 90s, but that's because we've focused on that resident experience and increasing those people that stay at our properties. So key things to look at right now. Concessions. With all these new properties hitting the market, they have to lease them up. Right? They have to offer something for these people to come in.
Free,
First month.
$250 credit, Visa card, whatever.
Yes, yes. So the percentage of units that are offering at least, a 1 month concession, it's like 49%.
Yeah, I mean, that's how you fill them in buildings that are challenging to fill. I can remember the one in Ohio, they're like, oh yeah, first month free or half month off or something like that. And that's the incentive to like get you in the door, get you to look at the thing. I'm not sure. So tell me your experience on how you combat that, because that's an industry practice that must work as it continues to work. But how do you keep people from being, you know, seduced out of your apartment by 1 month of free rent?
So it comes back to service.
Mm.
So if somebody's toilet has been going nonstop for 3 months, that's pretty annoying. But if you don't get to them, they're not going to renew, right? They're going to go somewhere else. So it starts again with that experience they have when they're at your property. And it starts with service. It starts with your maintenance team being on top of it. It starts with your maintenance team having the supplies ready so that they're not running back and forth to Home Depot 100 times a day to pick up the same thing, but that you're using certain inventory control measures so that you know on a monthly basis, I'm stocking the items that are routine, right? So that's important. And I also think that, you know, when you look at renewal time, if you've treated them well and they're happy with your place, but they looked online and they could get, you know, 1 month free somewhere else, it then becomes a conversation of, well, what's it going to cost you to move? On average, it was $2,500. So by the time they move, they've eaten up that concession that they were going to get. But most people don't stop to make that sort of a calculation. So it's our job to say, well, have you thought about this or have you thought about that? The
But
other thing,
Arleen, my cousin's got a truck. He's gonna come and do it for me. You know, like, and then you see the couch and the beds and the strap as they drive down the street.
yep.
New
But then
place.
they've got to pay new deposits, right? They've got to switch over the utilities and there's a cost
Hope
there.
they
And
get their
so,
last deposit back and da 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 da. Yeah.
right. So by the time that happens, we have a document that actually shows you what you pay every time you move. And that's something that we share with people. Have you considered these items? We're just trying to help you. And so those things are important. And then we do some other things, like we may replace their blinds, their, you know, faux wood blinds, cost us $48, but we retain that resident. So don't be afraid to do something like that. That's not going to cost you a lot.
Yeah, you could easily see, you know, hey, you want that $250 credit so important to you? Here's $250 worth of stuff into your unit. Or hey, I'll just give you $250 off your this month's rent and you don't have to move. So actually I saved you. What did you say it was 12 or 21?
$2,500 was the
Yeah,
average
so
cost.
I'll give you $250 and you say I just saved you $2,200. So.
Right. And I've seen other companies that will give gift cards, right? They might give $100 gift card to Walmart or to the local grocery store. And so the resident feels like they were given something that they are valued by the property. You don't always have to give something. If residents are happy, they'll tell you that. But I've also seen that rental increases aren't where they were coming out of the pandemic, right? I mean,
Yeah.
we're still seeing 5 to 7% on renewal increase, but a lot of people are seeing 0. So it's all about how you communicate with your residents and how you take care of them. We tell our team all the time, the resident holds all of our paychecks in their pocket. When they pay, we all get paid. So if you focus on the resident and you take care of them, the business will succeed and it will flourish, and you will flourish because we will have more opportunities for you to grow.
So on that note, what sort of upcoming projects or initiatives does REEP Equity you know, have in the pipeline that you're excited about?
Well, more AI generated tools for our team and educating them on the use of them. We're also doing a lot from a development standpoint for our team. Your maintenance team is often the one that's forgotten, right? And they're the hardest to find in today's world. So if we're giving them an ongoing training, if they become certified pool operators, or they can renew their HVAC or get an HVAC license or electrical or plumbing, one, it helps them on their resume. Two, they get a boost on their pay. And two, they stay with you because you just did something to help their career. So that is super, super critical, is to focus on your team. What does your team want? we bring in the full team 3 times a year. We bring in Houston and Austin. Austin's easy, 45 minutes away, but we put the Houston team on big buses, not your junky buses, but the nice limousine buses with TV and snacks and all of that. They come in 3 times a year. Start of the year, they hear what's on tap. What are our goals for the year? How do you as a team member fit into that goal? They buy into it, they learn it. And I've had people say that they've worked for other 30 years in the industry and never had any of that shared with them. So they're buying into it. We do employee events. We just had a family picnic. So not only did the employee come, but their spouse, their kids, their grandkids. We had 250 people at a ranch here in San Antonio. And the teams from Austin and San Antonio and Houston, they all got to know each other. And so if they wanted to reach out to them, they know them. They're no longer, oh, that's the Austin team or that's the Houston team. So all of that was, I think it has been a key. We had them write on a card what it meant to work at our company, because I wanted to know. The number one word was family, that it felt like working with family. And that to me was very rewarding. It's allowed us to be National Apartment Association top employer, because again, if you focus on people, this is a people business all the way around. And if you focus on your team, they will deliver if they are valued and they are respected.
So you guys are going to buy some more, then probably buy some more units, raise some more money, put some more investors into places. What does that look like real quick? Because I think we're running a little short on time, but give me the expansion. How many doors, how much more capital do you think you're going to need in your business for that expansion?
Sure. So last year we bought 4 when a lot of people didn't buy any. I think we raised 75 million last year, but prior to that we raised 150 million and bought 7 assets. So we're looking to buy 6 to 8 assets this year. Been a slow go. Sellers really aren't sellers right now, or not all of them are. So we're hoping to deploy another 150 to 200 million on 6 to 8 assets. We're not seeing as much distress as everybody was talking about. I think lenders are working through some. It's coming. We'll see some more. But there's still some good assets where the ownership has held the asset a long time. They're ready to move. And so we're seeing those opportunities right now.
Yeah, everyone's waiting for, it's kind of weird. It's like waiting for the bottom, and then it passes and you're like, oh, I guess that was the best it was going to get. And now everything's running up again. So I think the best time to own real estate is all the time. So buying it subjectively can be, we don't know until the tape, until the tail of the tape comes out, whether, oh, that was a bad time or a good time, especially when you're thinking, oh, I'm going to hold this apartment for 15 years on the scale of 15 or 20 or 30 years or forever. Sometimes you have to pay a few bucks to get a B class, especially in B and A class buildings. Like if you get lucky and you find a distressed B, good for you. But a B is still a B in 10 or 15 years. So
I agree. I mean, the last 7 we bought were at a 20 to 25% discount. So is it the bottom? Some people think we're near the bottom. Obviously, Blackstone just deployed a lot of capital to buy some assets, so they believe we're near the bottom. But regardless, it's a numbers game and it's a long-term game. We're buying not for today, we're buying for 3 to 5 years into the future.
Well, it's interesting you say that, because there was this report that was talking about 2008 had a steep bottom, a crash bottom, but there wasn't what they're calling it a hedge fund net. So like on a stock market, there's like a buy trigger that's like automatic, and they're just waiting around for it to hit that and they buy. So while we're all as investors expecting it to go and keep going, the hedge fund people have created the bottom. And so as soon as it gets close, they're like, buy. And if they keep raising it, the bottom is when the hedge funds start buying, they've defined it. There is nothing below that unless they decide they're not buying, which means they're just lowering their buy threshold. But if you see them stepping in your marketplace, that's typically what they're saying is an indicator that that's as good as it gets, because anything that comes up for less than that, it's gone, because they're just
Right.
they created the bottom. So if you
You're
see
right.
a hedge fund step on it, you're like, okay, well, that's, I guess, the best we can do in this market right now, because if we don't buy it, they're going to buy it when it goes just to the next threshold. They're just going to trigger buy it, never see it, never do anything. They'll hire someone to manage it. It'll just be another asset in the $378 billion portfolio or whatever they're dealing with. So I thought that was interesting, because there really wasn't that investor hedge fund buyer to support the 2008 crash. Can you imagine if we had a similar reaction, and these hedge funds, what would they have done? They'd have bought everything.
Everything.
We wouldn't even have been talking about, oh, I had to foreclose and I had to this and I had to lose my portfolio slowly over time. The hedge fund would have just went,
That's right.
grabbed it all, and that would have been the new bottom. So it's interesting that the climate that's created, especially in the multifamily side, when you look at, okay, I'm waiting for these buyers to be, the sellers to become sellers, true sellers. But as soon as they're like, we're waiting for this like feeling of, oh, I need to get rid of it and get a 30 or 40% discount. But these hedge funds are like, oh, 25 is good, buy. 25 is
Right.
good, buy. So it's
Yeah.
like we're competing with AI. It's automatically generating a report that goes to an office and some guy says approved, and they buy the building. So things to come, but I think, in B's and A's, like you're saying, decades later, it'll be worth, you look at anytime I'm looking at the market and I look back, I say, oh, what did that apartment block sell for in 1992? And you're like, $350,000. What's it worth today? $3.5 million. What's it going to be worth in 20 years? $35 million. Like, that's literally the game of real estate. You always look back and you say, I wish I woulda, I wish I
Right.
coulda.
Yeah. Our first property we bought was 19,000 a door.
Mhm.
And you're right. You look back and you go, boy, I should
I
have
wish
bought
I
10
would have
of
bought
those.
the whole town.
Right.
But yeah,
But you're right. I mean, you have $260 billion on the sidelines. 100 billion of that is earmarked for housing, multi-housing. So at some point, those dollars have to be deployed so they can pay their investors, and it's starting to happen. So if you bought in 21 at the height of the market, why aren't you buying now when there are incredible discounts?
preaching to the choir, Arleen. Preaching to the
Right,
choir.
right.
So with your plans, you're going to need some people to jump on board. We can't discuss it too much because now we're talking about fund level money, but how do they connect with you? What should they do? How do they find you to get part of the action as you guys grow in the future?
Sure, we'd love to have them. They can reach us by going to REEP Equity, REEP equity.com, or email invest@reepequity.com. And our investor relations team is ready to visit with folks. And my husband Jacob and I are on every one of those introductory calls. Either one of us is on to welcome folks and answer any questions that they may have.
Awesome, awesome. Well, I really appreciate the time. And for people who are scaling up, I'm sure they're going to enjoy this episode, because you really did drop quite a bit of tips and tricks that you probably would only learn by doing, what is it, 40, 55, 100 units. So if you're only at 50, maybe you could take some of these practices, apply them, and get that same result. I really appreciate it, Arleen.
Thank you very much for having me on. I've enjoyed it, and I wish everyone a lot of luck in this great buying market.
Yes, indeed. All right. Until next time, guys, we'll catch you on the next episode.
Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewyou.com. Now at moneypartnerformula.com, we help real estate investors to create a process for predictably getting capital so they can do more deals without relying on hard money lenders or the banks. We do this by building them a private capital marketing system. Now, if you want help turning yourself into a big money capital attraction machine, then book a call with our team to see how we can help. Just visit moneypartnerformula.com to find out more. All right, take care, and we'll see you on the next interview.